folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Happy New Year. Thought we'd come to you today with a brief market update, kind of let you know what's going on out there. S&P 500 right at about 6010, so just north of 6,000. That's below the December 6th high of 6090, but up a little bit since the beginning of the year. If you think about the sort of end-of-year trading pattern, we were down a little bit. We're up about 1.5% to 2% since the beginning of the year. Getting a little bit of that back now that everybody's back in their seats and a little focused on the market. I remind everybody that everybody who participates in the market, a lot of those folks take vacation too. And so it's not uncommon to see a little bit of volatility right around the end of the year, New Year's period, just because there are fewer market participants playing around. So in any event. Meanwhile, the 10-year Treasury rate is up to about 4.65%, which is pretty high, if we're honest. That is as high as it was back in April of 24, which, to give everybody a history lesson, back in April was around where we put interest rates on pause, and it's actually not that far away for this sort of overall peak cyclical high for the 10-year Treasury. Which was right just south of about 5% on the 10-year. So we're not that far away from it. And that's probably why you're seeing some of these headlines come through about how expensive mortgages are. It's not surprising. Mortgage rates are tied to longer dated interest rates. And so if 10-year treasuries are as high as they've been since April of 24, it doesn't surprise me, shouldn't surprise anyone else, that your mortgage rate is probably, or a new mortgage rate is probably as high as it's been since April of 24. And I just want to bring everybody to level set with what is going on, because I think it's going to be an important narrative for 2025. Right now, it all comes back to interest rates, inflation, and sort of economic outlook. You've got an unemployment rate that's right around 4.2%, so a little north of where we would like it to be, but not too much. And then we've got a sort of month-on-month core inflation rate that's right at about 0.3%, which is also a little north of where we would like it to be, but not terribly so. And so the Fed, and the expectation for the Fed is that going into 2025, I've got both of these indicators that are maybe a little higher than where I'd like them to be. And so the Fed has basically come out and said, we're not going to do anything. We're going to leave rates kind of where they are, let those two, that unemployment rate, that inflation rate, play out a little bit, particularly when the Fed thinks about the fact that if the Trump administration does go through with a tariff package, regardless of whether it is a broad-based tariff package or a targeted on certain industries tariff package, that will be inflationary. The Fed looking ahead and saying, well, I don't really see the need to cut rates into an inflation rate that's already a little higher than where I'd like it to be, with the knowledge that I've got some pressure on inflation coming later in the year. And so if you think about where our current Fed funds rate is, 4.5%, 10-year Treasury market looking at that and saying, we might be at 4.5% for a long time on Fed funds, or, only come down slightly this year. And it starts to apply a term premium for longer out into the future. And that's why you're getting this rate that's, up in the sort of mid to high fours, which is actually a good thing. It implies that the yield curve is no longer inverted. But it does mean that, equities are trying to sort out what does that mean in terms of discount rate? What does that term mean in terms of overall economic growth? Because remember, the Treasury rate, companies do borrow. It impacts their cost of borrowing and will ultimately impact a little bit of growth. So I think that at least for the early stage of 2025, we're going to be in a little bit of a wait and see game to see which way does the economy start to tilt. Do we start to see unemployment that becomes a little bit more of a problem and inflation less so? Or do we see inflation that becomes a little bit more of a problem? And that will, I think, dictate what direction the Fed is going to move over the course of the year. And we'll get our first piece of information on that actually on Friday, which is when the new payroll report comes out. Most people looking for the unemployment rate to kind of hang out around that 4.2% level. So with that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.